Hi, Justin Butler here of Eclipse Financial Services, who has offices in the Whitsundays and down in southeast Queensland and Brisbane and the Gold Coast. It's early May 2019 and this is just a quick video highlighting some issues with investment and superannuation statements that people have received in the last few months, which are measuring returns to the 31st of December last year. Typically you get statements at the end of June and also the end of December. So the graph that you can see here represents the Australian stock market in blue and the US stock market in green over the last 12 months. So that's from 1st of April last year to the 31st of March this year. Most of our superannuation investments are driven by returns in share markets. You may be in a more conservative fund where you mainly have 40 or 50% exposure, or you may be in a more aggressive fund where you have 70 or 80, but it's share markets that are doing most of the heavy lifting. So over the last 12 months, all markets around the world were growing quite nicely through to about October last year, and then in October through to December, most world stock markets fell around 20%, which is what's known as an investment crash. This was driven by concerns that interest rates around the world were going to rise. They've been at historically low levels for over 10 years. And the concern was that interest rates would rise significantly to where they were 20 or 30 years ago, and that this wouldn't be sustainable with the amount of debt in the world at either the consumer level, like it is in Australia and Canada with home loans, or at the government level, like it is in the US and a lot of the European countries, or at the corporate level like it is in China. Basically what happened is we had some announcements from the US Federal Reserve saying that interest rates sounded like interest rates were going to go significantly higher. Markets reacted by crashing over the next few months. Statements issued as at the 31st of December showing quite bad results. And then the US Federal Reserve stood up and said they acknowledge that with the level of debt around the world nowadays, interest rates won't be going up to the sort of rates they were in the 90s and the noughties and the 80s, and that nowadays interest rates would fluctuate through a much lower band. Consequently, stock markets rallied in the March quarter of 19 and made back all the losses that they'd had in the December quarter of 18. So the final graph to show you is those two same stock markets, the Australian stock market in blue and the US in green. This graph goes back 20 odd years. So you can see in green here where the US stock market was affected by the tech bubble in 2000, and you can see the global financial crisis in 2017. Despite both of those events, long-term quality blue chip shares are driving returns of averaging out at around 9 to 11%. And we shouldn't get distracted by short-term falls. That short-term fall there is the last 6 months that we were talking about on the last slide. And as you can see, markets are volatile, but ultimately you're getting a long-term average that's a lot better than you'd be getting in cash and fixed interest. Look, I hope this video has helped you understand your 31st of December 2018 statements. If you have any further questions or would like anything clarified, by all means, just give us a call at Eclipse Financial Services. Thank you.